Hi, and welcome to the Australian 2019 tax year. Let's talk about what you need to know for the year ahead in the world of tax. One of my favourite worlds. We're going to run through 6 changes. Firstly, let's talk tax rate changes. From 1 July 2018, a new low and middle income tax offset will come into effect. You're entitled to $530 if your income is less than $90,000. The offset phases out as your income increases, and you're no longer entitled to it once your income exceeds $125,333. The HO will apply this offset when you lodge your return for the 19 year, so you won't see any immediate benefit. However, taxpayers will benefit from a slight increase in the 32.5% threshold. That's changed from $87,000 to $90,000. Now let's turn to superannuation. 4 of our 6 changes are in this area. You can be forgiven if you're more successful in keeping up with the very famous family than keeping abreast of changes to Australian super. Now let's get to it. From 1 July 2018, you can now carry forward the part of your concessional contributions cap that you didn't use. So say you had contributions of $15,000 put into your fund this year, and the cap's $25,000, you can carry forward that $10,000 and use it in future years. Now this carry forward rule only applies for 5 years, and only if your total super balance is less than $500,000. Let's talk about the spouse tax offset. A $540 offset that you can get if you contribute into your spouse's super fund and you meet certain criteria. Well, from 1 July 17, the criteria has been relaxed, meaning more people are now eligible to that offset. To get the offset now, your spouse's income must be lower than $37,000 and both you and your spouse are Australian tax residents. Now onto super and property. From 1 July 2017, there has been a first home super saver scheme. You can make voluntary contributions into super to save for a deposit to buy your first home. It's possible to make up to $30,000 of contributions to this scheme. The tax savings can be in excess of $4,500 when the contributions are released. Now there are rules around it, but well worth considering if you're looking to buy your first home. Now, if you're looking to downsize your home, there's also a super change worth noting. There is a Downsizer super scheme. If you're over 65 and you sell your main residence, you can make a contribution of up to $300,000 into your super. And this contribution doesn't count towards the super caps. This is a great way to get money into your super fund. Now there are rules around this. You have to have owned the property for at least 10 years and you can pop more money in if you own the property jointly. On to our last change now, and this one concerns the tax on your main residence. Currently, if you sell your main residence, the gain you receive is probably free from capital gains tax. But this could change. There is legislation in Parliament that will mean if you sell your main residence when you're a non-resident, the capital gain will become fully subject to capital gains tax, no matter how long you may have owned it or lived in it. This measure will impact Aussies that go offshore and become a non-resident. The removal of the exemption is intended to apply to properties sold after 9th of May 2017. Although, under transitional rules, you're still entitled to the main residence exemption if you sell it as a non-resident before 30 June 2019. This measure is not yet law. It's still being debated in Parliament. More information will be released by the government as the legislation takes shape. Given the start date of the measure, that it will impact properties sold after 9th of May 17, we strongly urge you to seek advice before selling your house if you're thinking about selling it as a non-resident of Australia. Well, that's it for me. You're now free to exit the tax world, or stick around. It's been lovely to talk tax with you. If you'd like to chat about your taxes further, please get in touch with your usual PwC contact or one of the people listed here.